Have you ever stared at a price chart and just seen a chaotic mess of red and green lines? Random, indecipherable noise? A lot of people do, but they're wrong. Welcome to the Secret Language of Charts, the definitive series from Money Talks U.S., where we're going to teach you how to read that chaos. Because a chart isn't just a collection of data, it's an X-ray. It's the fingerprint of human psychology on a massive scale. It's a battlefield where the fear, greed, hope, and despair of millions of people clash every single second. Chart patterns, the formations we'll study in this series, aren't magic. They are the visual manifestation of these battles. They work because human nature doesn't change. The reactions of the masses to uncertainty and opportunity are predictable, and they leave tracks. Learning to identify these tracks is the fundamental skill that separates the amateur from the professional. In this first episode, we're not jumping into complex patterns. That would be like trying to build a skyscraper without a foundation. Today, we're going to forge that foundation. We're going to install the operating system you need to understand everything that comes next. We'll talk about the three pillars of chart analysis: the trend, support and resistance, and volume. Master these three concepts, and the language of the charts will start to make sense. Ready to go beyond the lines? Let's begin.
The first commandment of a technical analyst is simple, yet profoundly ignored by novices. The trend is your friend. Trying to trade against the main direction of the market is like swimming against a strong current. You might make a few feet of progress, but exhaustion and the risk of being swept away are immense. But what exactly is a trend? It's not just the prices going up, it's a structure. First, the uptrend. Its anatomy is a sequence of higher highs and higher lows. Watch this. The price makes a push upward, creating a high. Then it pulls back but stops at a level higher than the previous low. And from there, it launches another push that surpasses the previous high. This is known as a structure of higher highs and higher lows. Psychologically, this is pure optimism. The buyers are in absolute control. Every small pullback isn't seen as a sign of panic, but as a golden opportunity to buy more at a relatively cheaper price. As long as this structure of ascending highs and lows remains intact, the uptrend is alive and well.
Now, its counterpart, the downtrend. It's the perfect mirror image. Here, the structure we're looking for is the series of lower lows and lower highs. A lower low followed by a lower high. The price falls, creating a new low. It tries to recover, but the bounce is weak and stalls below the previous high. From there, selling pressure returns with force, pushing the price to a low that's even lower than the first. This is market pessimism. The sellers are dominant. Every small rally is an opportunity for bears to sell or open short positions. The trend is clearly down.
Finally, we have the sideways trend, also known as a range or consolidation. Here, there's no clear direction. The price is trapped between a well-defined ceiling and floor. It's a stalemate, a balanced battlefield between buyers and sellers. Neither side has enough strength to take control and create a new structure of ascending or descending highs and lows. Psychologically, this represents indecision or equilibrium. Often, these sideways phases are just pauses within a larger trend, or they can be the breeding ground for a major change in direction. Trading in the middle of a range is one of the most common traps for beginners. The real opportunities are found at the extremes of that range or by waiting for the decisive breakout. Correctly identifying which of these three phases the market is in is the first and most crucial step of any analysis.
If the trend tells us the direction of the river, support and resistance levels mark its banks. It's critical to understand that these aren't exact lines drawn with a pencil. They are zones. They are areas of the market's psychological memory. Let's start with support. A support level is a price zone where buying pressure is strong enough to halt a decline and ideally reverse it. It's a floor. But why does it form? There are three main forces working together. First, buyers who believe the asset is cheap at that price and see it as a good investment opportunity. They place their buy orders there. Second, traders who sold higher up and now, seeing the price fall to a level they consider fair, decide to get back in. And third, and very importantly, short sellers taking profits. Someone who shorted at a higher level needs to buy to close their position and lock in their profit. This mass buying adds enormous upward pressure. When these three forces converge, a strong demand zone is created, a floor. Resistance is the opposite concept. It's a price zone where selling pressure overcomes buying pressure, stopping an advance. It's a ceiling. And again, it's formed by the confluence of three groups. First, traders who consider the asset expensive at that level and decide to sell. Second, buyers who got in at lower levels and choose this zone to take their profits, selling their positions. And third, regretful buyers who didn't get in before and see this level as a second chance to sell, hoping the price will drop so they can buy back cheaper. These three forces create a massive supply zone, a wall that is tough for buyers to break through.
Now for one of the most elegant concepts in technical analysis, the polarity principle. When a support level is decisively broken, it tends to become a new resistance, and conversely, a broken resistance becomes a new support. Think about it. The zone that was once a floor defended by buyers, once broken, now becomes a ceiling. Those who bought at that support are now at a loss and will wait for the price to return to their entry point to sell without losing money. Those who missed selling at the previous resistance now see a second chance. This role reversal is a pillar of price action analysis.
So far, we have the direction and the key levels. Price tells us what is happening, but volume tells us how much conviction is behind it. Volume is the fuel. It's the signature of smart money. Ignoring volume is like driving a car looking only at the speedometer without checking the fuel gauge. First, trend confirmation. In a healthy, strong uptrend, we should see volume increase on the up moves and decrease on the pullbacks. This tells us there's enthusiasm and mass participation when the price rises, but apathy and little interest when it corrects. This is a sign of strength. In a downtrend, it's the opposite. Volume should be high on the drops and low on the bounces. If you see a trend advancing on declining volume, that's a warning sign. The trend is running out of gas. Second, and perhaps its most important use, is breakout confirmation. Imagine the price is approaching a key resistance level that has held for weeks. Finally, it breaks through. Is it a real breakout or a trap? The answer is in the volume. A breakout accompanied by a massive spike in volume is a sign of high conviction. It means that big players, institutional money, have entered the market sweeping away all available supply. This is a breakout that has a high probability of being genuine. Conversely, a breakout on low or average volume is extremely suspicious. It suggests there's no real force behind the move and could be a bull trap designed to lure in unsuspecting buyers before the price sharply reverses. Always wait for volume confirmation. Finally, volume helps us spot trend exhaustion. Sometimes, after a prolonged move either up or down, we'll see a candle with a huge range accompanied by a climactic volume spike, the highest in a long time. In an uptrend, this is called a buying climax. It's the moment when euphoria is at its peak and the last, least informed buyers jump into the market for fear of missing out. Often, it's precisely at this point of maximum euphoria that professionals sell their positions, marking the market top. In a downtrend, it's called a selling panic or capitulation. The last holders of the asset, desperate, sell at any price. This final act of surrender, paradoxically, often marks the market bottom, as there are no more sellers left. Volume isn't just a bar at the bottom of your screen, it's a window into the market's energy and intent.
And there you have it, the three foundations upon which all chart analysis is built. The trend, which gives you the overall context, support and resistance, which give you the map of the battlefield, and volume, which gives you the confirmation of who is winning that battle. Do not underestimate the importance of these concepts. Every pattern we study, every strategy we develop will depend on your solid understanding of these three pillars. They are your compass, your map, and your fuel gauge. We've laid the foundation. Now we're ready to build. In our next episode, we'll take a quantum leap and start analyzing the market's earthquakes. We'll talk about the patterns that signal the imminent end of an uptrend, the formations that scream danger to buyers. We'll explore the giants of change, the famous head and shoulders pattern, and its cousins, the double and triple tops. You'll learn their anatomy, the psychology behind each phase, and how to project their price targets with astonishing accuracy. If you found this first step helpful, make sure you subscribe to Money Talks U.S. and hit the notification bell so you don't miss the next chapter of The Secret Language of Charts. The real game is about to begin.